It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, as always, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
It's almost a universal question in every client meeting these days. During an election year, everyone's wondering, is it safe to invest with such a big election coming up? We hear it all the time, don't we? So we're going to be sharing what history says about election years and how you can invest for this one in November. That and more on today's episode.
That's right. And definitely getting into some questions from fans of the show. As Josh mentioned, this is this sort of prevailing question. So if you have a question for the show or need any help, we are here to help you. You can call or text us 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can find us. You can submit questions, reach out to us that way as well. And then all over social media, wherever you are, we are there as well. And you can connect with us that way as well. Where to start with the election and investing? Let's just, I guess, get this out of the way. You know, the Wise Money Show is a show about financial planning, comprehensive financial planning. There's 6 areas to your financial life. And the big idea that we've just seen as like a truth, the best way to make great financial decisions, not good financial decisions, great financial decisions, is to look at all 6 areas of your financial life and see how those choices will influence those 6 areas. And you want to make the decisions that will bring synergy to those 6 areas. So here's the question. Are your politics, should they be part of that? Or should they be separate? Specifically with your investment planning, that's the 4th area of your financial life. Should your politic feelings be connected to your investing behavior and financial behavior, or should they be separate?
I love the way you framed that. And the fact that you started with the reminder that the best financial decisions happen in the context of all 6 areas of your financial plan. It does feel like a lot of times there's a temptation to throw all that out the window during an election year and try to make your decisions based on some kind of a prediction of who's going to win and what the next 4 years will bring when they do. And man, I feel like the inventory of financial mistakes that I have observed, the big ones always happen in an election year. And it's some kind of emotional response to your guy or gal not winning or the other side, taking office and you believing that it is incomprehensible that something good could come over the next 4 years. So I've got to move to safety mode. And you forget that there were optimal decisions that you were in the process of making in your financial life. And you're allowing the noise of the media and everything during an election year to take you off your game. And boy, I needed that reminder. I'm glad you started that way. That was good.
I mean, because here's the reality. The election matters. Your vote matters. Your choices matter. Your perspective, your thinking matters, right? And it does feel like each election is getting more crucial, more pivotal for our world, for our economy, for our stock market. And yet at the same time...
Well, when's the last election that wasn't framed as this is the most important election in our lifetime?
Right.
They've always been that way. Yeah,
I know. So
because they need you glued to your TV, right? Yeah. The people who are sharing that opinion want your attention.
Right. And so if you look at that and your guy is likely to win, you're likely to feel optimistic. And if your guy isn't, you're likely to feel pessimistic. Mm-hmm. And therefore, it's possible you tell yourself a story, this time it's different, and therefore I need to take some control because I feel like I'm losing control because my tribe, my guy, my ideas, whatever, will not be represented.
Yeah. Mm-hmm. And so that's where I guess I would validate that your feelings and your perspective on the world and politics and some of the decisions and who should be in leadership, because it's important. And And yet at the same time, so the stock market is the culmination of the value of the greatest enterprises on the planet. And whether it's purple policies or green policies or whatever, yellow policies, it doesn't really matter. Those businesses are trying to navigate that landscape so that they can continue to deliver value in the marketplace. I know this is going to sound geeky like an economics textbook, trying to deliver in whatever the climate, whatever the situation, whatever the laws, whatever the taxes, whatever the scenarios, trying to deliver value to the public. Mm-hmm. And then when they're able to do that, there's value created in accretive in their shares.
That's right.
And so I, at all times, want to be an owner in the world's best enterprises, regardless of the circumstances, or what headwinds could be coming, or tailwinds we could be enjoying. I want to be an owner in the best enterprises on the planet that are navigating whatever the climate.
It's so great to frame it. Being a stock investor is being a business owner, as you said. And these are some of the best companies in the entire world. And businesses are not driven by exclusively by what happens in the White House, not by what happens in Congress, not even by the Fed exclusively. They have influence. They have policies. They're creating the environment, changing the rule book that these companies have to play by. But they have a pretty phenomenal track record at making the right adjustments as the political environment changes. And you do want to be an owner in that. When you think of the stock market as businesses, it lets you have a little bit more level-headed response, as opposed to the stock market being this crazy animal that is unpredictable, and the only way to have a sense for what it's going to do next is determine who's going to be in the White House.
Yeah. So that's where I think we would validate that it's very important, your political views and your vote and all of that, and yet at the same time, do your best to humbly separate the emotions about your viewpoints in Washington and your investing behavior. And we're going to get into some of the data. We're going to walk through 3 myths that are very common that you've either thought or you will hear. You will hear these spoken as truths, but they are myths that often come along in investment years. And before we get into those, though, people have been talking about this fear of, or this theory, I guess, of how does the stock market behave in relation to what's going on in the White House. Mm-hmm. And they've called it, and we studied it back when we were, getting our Series 7s and our CFPs and all of this. But it's been a theory that's been around for maybe 100 years, long time, and they call it the presidential election theory. Mm-hmm. And essentially looks at, well, can you map and find any pattern between the year of a president's term and how the stock market performs? So, Josh, what does history tell us? What does that theory tell us?
I'll tell you specifically what does it show us about an election year. And if you look back since 1928, there have been 24 election years, and 20 of them have been positive in the stock market. So only 4 times have we had a negative year when we're going to the polls to vote. And of those 20 positive years, 3/4 of them are very positive. They're double-digit returns. And so if you're just wondering, if you're trying to decide this year, is this a year to be more conservative or stick to the long-term plan and be confident and hopeful that it's a positive year for you, I would lean towards positive for sure.
Yeah.
Just because of history.
But think positive in terms of your long term.
For sure.
Don't think positive in terms of, I need to make some money because I'm buying a car next January, and so I'm going to roll the dice. Do I do it here in the stock market? Do I do it at the Four Winds? No, don't. No, this is your long-term money. This is not, we need a new refrigerator at home in November, December, so let's go all in with this money on a penny stock.
Yeah,
absolutely.
Well, I want to break down the years then in this presidential election theory, but Josh, you're absolutely right. I'm glad you kind of zoomed out. So 4 out of the 24 years were negative, and that lines up pretty close to long-term averages. 75%, so between 75% and 80% of all years are positive in the stock market, even if that's an election year. In fact, a little bit stronger if it's an election year. We're going to break down the presidential theory, okay, and how it overlays what history tells us about investing during the election, and then 3 myths that you're likely to hear. We got that and more coming up on the Wise Money Show with Korhorn Financial Group. By the way, that word was myth. It didn't come out quite right. All right. Hey, YouTube, thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time, every Saturday morning, also on podcasts at the same time, but also on a couple local radio stations, which is why we have segments and breaks and, and it's a talk show. So we talk and banter. But there's a lot of other content right here on this channel. Takes one financial concept, applies it directly to your financial life from a comprehensive financial planning perspective and viewpoint, helping you take your next wise step. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. If you like the content, share it as well. We appreciate it. All right. So there's a little bit more. Josh, that was perfect. There's a little bit more we can share about the presidential election theory, and then that flows right into myth number 1. And we'll probably not get to all myths this segment, but we'll see. Second segment, here we go. Is it safe to invest during election years? This is the pervasive financial question right now. Likely you've had it, you've heard it. We're blowing up the myth right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com. Then all over our social media, we are there, or wherever you're at, we are there as well. Search the Wise Money Show. All right. Likely we're going to do a couple of shows focusing on the election and the markets and the economy and all that. And the first one, we're taking the myth busting approach, because it just lots of emotions with elections and policies and everything, and emotions and investing are like oil and water. Oftentimes your emotions lead you to make bad financial decisions, specifically investing decisions. Presidential election theory, for decades and decades, maybe a century, they've overlaid a president's term to see if there's any pattern in the stock market. And there's really one clear pattern. Stocks tend to do well.
Yeah, that's right.
Stocks tend to do well. Do they always do well? No. 50% of all days are negative, 50% are positive. But month, the odds get better. Quarter, the odds get better. Years, the odds get better. 3 years, odds are better. 5 years, odds are better. And so stocks tend to do well. Now, first year of a president's term, on average, 6-7% rate of return. Second year, it's a little bit lower, 3-4% rate of return on average. Second year of a president's term tends to be the worst. I'm just going to spoiler alert right there. Third year tends to be the best, averaging double-digit returns when you go back over the past, 60, 70 years, something like that, maybe 100 years. Fourth year is the election year. It's the second best year on average of a 4-year presidential. When you look at that data, it's the second best performing year on average, the election year.
Right. But if you go back just to the data to 1928, like an election year, we're doing 7.5% in the stock market. In a non-election year, we're doing 8%. So right. if you smooth it out, but here's the thing: who is allowed to smooth anything out? You can't. We're absolutely bombarded with this is up and this is down and this happened and this is going to impact this and we're going to run out of oil and we're going to burn the earth up and we're going to do all this stuff, and everyone is kept right on the edge of spastic. and if you just said, I mean, we could actually take this hour-long show and make it a 30-second show and say, hey, listen, here's what happens in election years. You're going to get 7.5%. Non-election, you're going to get 8%. And you will never get those exact returns. Right. But over time, and if you'd been investing since 1928, that's exactly what you would have gotten.
All right, so myth number 1, okay, and we're already into it. Myth number 1, stocks don't do well in election years. You're going to hear this in the hysteria on different, talk shows and in the media. You're gonna hear it. You're gonna feel it because your emotions are going to get higher and higher the closer we get to the election. And yet, the truth is, stock returns, just like Kevin said, don't really differ that much between an election year and a non-election year. That's what history says.
Stocks don't care. We care. That's the confusing thing. We care so much about it, and we project that, certainly the stock market does. It doesn't.
Yeah. So whether it's the first year, whether it's the election year, whether it's the third year, stocks tend to do well. So the name of the game is, do you have a long-term plan and long-term strategy for your investments? We've said, before, if you gamify this, investing is like coaching a basketball team, or I prefer hockey, same sort of scenario in this analogy, not football. In football, when you've got the ball, you put certain players out there. You even have a separate coach that's calling the plays. When you lose control of the ball, you swap it all out. You change everything. And even a different coach is calling the play. That is not how investing works. How investing works, you are picking a group of players to go out on the ice, and when you've got the puck, they're trying to score. When you don't have the puck, they're trying to play defense. And guess what? It's that quick. If you're not a hockey fan, you might say, I remember I prefer when they would put that highlighter over the puck because I can never know where it is. It's that quick. We're on offense, defense. Wait a second. We had the puck and then we just dumped it in. Why did we do that? It's so fluid, and that can make you feel like the stock market's erratic and so on. Should we be on offense? Should we be on defense? Guys, you need to pick a long-term investing strategy that's the right strategy when you've got the puck, and the same strategy when you don't.
That's right. Sometimes it's important to pause and consider, how many different presidential elections am I going to live through? How many cycles of the economy being up and down am I going to live throughout the rest of my life? And so it makes any one cycle a little less important, a little less emotional for you when you do keep that long-term perspective that you're talking about.
All right, now here's the biggie. You thought that was the biggie. You thought we'd start with the biggest myth, and I think I think it summarizes it. But the real big myth is the second one. Markets are going to go down if so-and-so wins. Mm-hmm. And I'm going to say it more clearly because on the date we're recording this, earlier this week, there was an article where the headline said, if blank wins, will the market crash? So it's not what you're feeling or what you're seeing isn't markets will go down if so-and-so wins. No. It's going to be exaggerated. Mm-hmm. And markets are going to crash if so-and-so wins.
Well, that's the perfect example of not allowing your brain to have any kind of smoothing effect and context to say, hey, over the long term, this happens. Because that's what we are being bombarded with that. And they're saying, hey, if this guy wins, democracy is over. If this guy wins, there's going to be, all these things happening. And it never, to me, the best example was in 2012, and I had clients that said, if President Obama gets reelected, our country is done. Our country will not survive another 4 years of President Obama. And I've lived long enough to hear people say that about each candidate.
Yeah.
And so they said, hey, I want to take some money and get it off. I'm going to get it on the sidelines. The folks that did that missed out on a huge run-up because 2013 was the year. 2014, 15, and most of 16 didn't do anything. So, and what are you tempted to do after there's a nice run-up in the market? Well, let's get in. Right. And so behaviorally, folks that tried to determine what the future of the country was going to be and therefore the future of the stock market based on a certain candidate. And I saw that hurt people in a meaningful way.
Mm-hmm. Throughout this year, there's going to be more and more chatter, more and more talk about what's the mix of government going to be when the election is over, right? I mean, we tend to talk about the presidential election, but there's a whole bunch of voting going on throughout the country beyond just who's going to be in the White House. And a lot of research, a lot of energy goes into figuring out throughout history which team's better on the whole. And there's really 4 different scenarios that could play out in an election and usher in at least a 2-year period of time where we either have a unified government where there's a Republican in the White House and Republicans control Congress, or a unified Democratic government. You could have divided Republican in the White House and Democrat Congress, and then the opposite there as well. You could have Democrat president and Republican Congress. And the question is, of these 4 different scenarios, which one's best?
No. I'm going to ask a different question. Of those 4, which one does the stock market go down?
Okay, I was going to say that for the end.
Oh, okay.
You stole my thunder. All right. The spoiler alert here. They're all good, right? Yeah. All 4 scenarios work out well for you if you're a long-term investor. The one that wins throughout history has been Democratic president and Republican Congress, followed closely by unified Republican scenario.
And we're splitting hairs. They're close.
That's right.
Right? And so sorry for
high
stealing the thunder.
double digits on both of those scenarios.
Yeah. And you can think, yeah, but they weren't dealing with this much government debt back then. And they weren't dealing with, the prospects of, of bigger, war and conflicts and everything. And yeah, we were dealing with a whole bunch of stuff back then. It feels different right now, but in many ways it was the same. It was the enormous concern. So more data on what history tells us if so-and-so wins, how does the stock market do? And then the third myth, all that more coming up on the Wise Money Show with Korhorn Financial Group. Sorry.
That's all right.
Okay. Because I think the reason why you were going there, and I wanted to make sure you went there, was, emotionally, we feel, everyone, if this mix, the market's going down. Mm-hmm. And in short time periods, absolutely, that's happened, and it will happen.
As a long-term investor, the world is skewed to your favor. On the whole, it's more likely to keep on winning for you. Yes, there's interrupted years, and yes, some will be better than others, but on the whole, be a long-term investor and don't let the short-term throw you off your game, right?
All right. Third segment, we're racing. We're going to get through both of these myths, and then probably fourth segment will be questions.
So the myth that we're going
to hit this. We're going to
number 3.
Do more
number
of the
2 and 3.
Yeah. So we're going to finish 2 and then get into 3.
So markets will go down.
Yeah. All right. Here we go. Have you felt if the election goes a certain way, I should get out of the market because that's not going to bode well on Wall Street? We've all felt that way. What does history tell us? We've got that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast wherever you listen. Search the Wise Money Show, subscribe to it there, and then rate the program there as well. We appreciate it. All right, so busting some myths today about investing during election years and investing with politics. And the kind of overarching theme is your political views are very important, and yet those views really are best kept separate from your investing decisions. History tells us that. And one myth is, stocks tend to not do well during election year. Things are so polarized and there's so much at stake. That's not true. Election year, non-election year, they're actually pretty similar. And of the 4 years of a presidential term, the fourth year, the election year, is on average the second best. Second myth, though, we're in the middle of, and that is if so-and-so wins, though, the markets are likely to go down or are going to crash. So if you go back to 1960, and I haven't counted here how many elections that is, I don't know, 16, 17. And you just look at what's happened since Election Day and year end. On average, stocks are up. On average. There are 3 times when the market is, I'm going to say flat, down 0.5, down 0.2. Okay. So yes, down, but I'm going to say flat since election day to the end of the year. There are 2 times where the market was very negative. And it turns out those are very heavily correlated with significant economic issues that likely had nothing to do with the election.
Mm-hmm.
Yes.
The election during the tech bubble, okay? No one calls that the presidential bubble. It is the tech bubble. And the election during the great financial crisis. And I actually, there was a pocket of time, as much as I'd love to forget that, there was a pocket of time where there was a pretty significant rally at the end of the year, whether that was due to, Wall Street liked the results, or there was a Santa rally or something. But if you look at this waterfall, painful experience of the great financial crisis, the Great Recession, there was actually an increase in that November, December timeframe for a period, and then before the waterfall continued in March. So the truth here is that the economic issues are far more likely to drive the near-term stock market behavior than the election result.
Mm-hmm. I agree. I mean, the trends that are in place throughout this year, the economic climate that we're in, the president has some influence, Congress has some influence, Fed has quite a bit of influence, but it's just influence. It's not control, right? Mm-hmm. And these things are natural cycles. It's you and me as consumers either spending or not spending. It's our own financial health kind of in the aggregate, as a one big conglomerate. How are we doing as an economy? And yes, it's with that as the backdrop, we go to the polls every 4 years, right? And ultimately, you're picking someone that you believe will help create an even better backdrop or environment for the future. But man, the president, I always say, gets way too much credit and way too much blame for how the economy is doing and how your investment life is doing.
Yep. I'm going to add just a couple more things and then we'll move on. I've got a chart here that's got their smiling faces and showing, going back to the Reagan era, over that presidential term, how'd the stock market do? Going back to Reagan, there's only 2 times where the stock market was negative, and that was both terms of George W. Bush. And I would argue, that's tech bubble, and that's great financial crisis. That's the lost decade era. I don't know. You could say, yeah, it was Bush policies that influenced part of that. I wouldn't say it was Bush, period, that was the cause of that. All of the other ones are positive. And if you want to look and say, well, but which one was the best? Which one was the worst? They're actually pretty similar. Pretty stinking similar. So you're going to have your own political views. I've got mine. And yet those should be kept separate because regardless, stocks tend to behave a certain way.
Yeah, but the other thing is, if you look at the greatest investors of all time, they don't have policies, at least macro policies that say, okay, I own this company, I'm going to sell it. You look at Berkshire Hathaway, if Warren Buffett makes that list, and he's not buying and selling these companies. See's Candy is not on the block if he thinks that the election is going to go a certain way or not.
Yeah.
So this is where great investors think in terms of 20-year cycles, not the next 20 weeks and what's going to happen.
Yep.
All right. So myth number 3. If you were to ask me, going back, I think Josh referenced this earlier. Okay, does Wall Street care about who's in the White House? Not really. Wall Street, I would say, cares way more about who's chairman of the Fed. In my opinion, the Fed drives more of economic policy than I think White House does personally. And so third myth is, well, the Fed's not going to make any changes to their policy during an election year. They've got to be hands off and just let the election happen and stand back. And the reality is that is definitely not true. Mm-hmm. There are several times, I've got the chart in front of me, where the Fed will raise rates or will cut rates even in an election year. So even though this is the part that makes me, well, there's a lot of it, but makes me want to throw up my mouth a little bit when I hear it connected to politics. But when when candidates or the president talk about manipulating or influencing the Fed in one way or another, those are intended to be very separate and not connected, not have counsel, not have collaboration. Those should be very separate. And the evidence suggests, even if this time might feel a little bit different, the evidence suggests that they are separate. Fed policy is going to be Fed policy, regardless of it's an election year or not, regardless of who's in the White House or not.
Yeah. And you could be a conspiracy theorist and see that how the Fed's change in policy maybe swings an election. You know, an interest rate cut at just the right time in an election year maybe kind of takes people, takes the temperature down a little bit in the economy or amongst voters or whatever. And that could happen. But
I mean, you can see it setting up that way.
Oh, yeah,
right.
right.
Right now, we're looking, and we just got really bad reads on consumer confidence, likely connected to, well, the Fed's going to start lowering rates, right, and make it easy on us consumers, right? And no, they haven't. And now people are saying, okay, Fed's only going to do one cut this year, and it'll be right before the election. You can see it playing out that way. And yet,
and it happened in 2012, if I remember correctly.
Yeah.
You know, it wasn't looking fantastic for Obama's second election, but some changes in policy there in the fall. And I remember thinking, wow, this may set things up and turn things around for Obama. Who knows?
Yeah.
Yeah, in 2012 the rates did not get increased or decreased.
Yeah, as a whole.
Yeah. I mean, this is the amazing thing, and it is tempting to go on the day by day, even on a day when Jay Powell comes out and makes an announcement and the market jumps up and then jumps back down almost immediately. And this is where the noise is deafening. And this is where you need to put on your headphones and, listen to Barry Manilow or something.
So I thought you were going to say wax in your ears and be
strap me to the mast. Yeah.
And I guess that's the overarching. Before we turn and get into listener questions, I guess that's the overarching takeaway. And I've got strong policy views and have concerns about where the world is and some of the things that we're doing, especially from financial policy and government debt and all these things. I've got those concerns too. I talk about them on the YouTube channel. Go check it out. Yet at the same time, got to keep those emotions in check and separate from your investing decisions. And going back, Josh, to what you said, I don't know if you want to share it again, but how emotions often lead to poor investment decision making. That is, yeah.
And that's one of the functions of having a certified financial planner who's helping bring you back to the long-term plan. Your comprehensive financial plan should be driving your investment strategy, not what's happening in a political year.
Yep, that's right. That's right. So work with your CFP. What's your long-term strategy? Stay connected, stay strapped to that mast, regardless of what's going on and what you hear in the media as we lead up to the election. All right, we got more coming up on the Wise Money Show with Korhorn Financial Group. I knew you'd have something great to just plug in there. That was good.
Well, you basically set me up.
Forced it?
Right.
Or yeah.
Okay, so we're going to the fourth segment?
Fourth segment.
Questions?
Yeah, first question we're going to hit comes from Ramble.
I think you already hit the first question.
Rumble, yes. Can I make my underage grandchildren the beneficiaries of my Roth? Ooh, that's a goodie. Because the answer is yes. But we can talk about, well, why would you do that? And what are the risks? But what are the benefits? And
because...
And then we might hit David's question. Okay. We might hit Donna's question.
Can you remind me on that one? If I'm underage, I get more than 10 years, right?
Right. The 10-year clock doesn't start until you reach age 18, age majority. And then you've got 10 years.
Well, I think when I look back on my life, and I think the wisest period in my life was probably from 18 to 28.
Yeah, me too. So we'll talk about pros and cons. That actually could take the entire segment. We'll see, because there's lots to hit there. But all right, here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFT studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, as well as a lot of other content, is on the YouTube channel and other platforms as well, by the way. That's a lead into where we're going. And so go to YouTube, search the Wise Money Show, subscribe to it there, and turn on notifications so you're made aware every time we drop new content, because not only is this talk show there, but lots of other content that we drop all throughout the work week, well over 1,000 videos. Go to YouTube, check it out, search the Wise Money Show. Jumping into questions from fans of the show, and of course what we've been talking about, election and investing. Obviously, we get lots of questions on that. We will continue to do so, and I'm assuming do another show or two about that very topic. But jumping over to a question from a fan on the Rumble platform, can I make an underage or my underage grandchildren the beneficiaries of my Roth IRA? Great question. And here's why. Because there's the fact, there's the answer, and then there's the context and the should you and the, well, what are the benefits and what are the potential risks?
Most grandkids aren't out there thinking or fantasizing that their parents or grandparents are going to leave them a Roth IRA, right?
I actually am thinking,
will they leave me a car or, something cool, but
I think this is planted. This question was planted by a grandchild that wants us to answer, and then it's going to share it with grandma.
Can you? That's right.
Yeah.
Send the link to my.
Yeah. So what's the direct answer? Because there is a factual answer. Is there an age limit on needing to be listed in order to be listed as a beneficiary?
So you can leave investment accounts, whether they're Roth IRAs or just a normal brokerage account, behind to kids. The issue is that they have to be a legal adult in order to have that account fully in their name. So if you have children under the age of 18 who inherit an investment account like this, there's going to be some sort of a custodian or a guardianship or maybe a trustee in place, an adult who's managing the money for them until they're old enough to take over themselves. And in a lot of states, that's age 18. There's some states where it's all the way to age 21. But the question, and we probably shouldn't jump ahead too quickly here, but it's, should you allow a kid to have control of the money at even 18? Are they ready at that time? Mm-hmm. And plenty of kids have unfortunately made some mistakes with their finances because they inherit money too early, essentially. They're just not ready. They don't have the skill set. Maybe they really haven't even developed their brain entirely. I mean, we could get into the science behind all this. Mm-hmm. They're not ready to make huge decisions. Now, if we're talking leaving behind a small piece of an overall Roth IRA, it's $5,000 or something like that, could still be a blessing right as they're going to college and maybe help with some big expenses or something. But unfortunately, the question of should you has to get answered as well as can you or how. Yeah.
So some of the laws, some of the rules. So yes, you can. And as Josh said, if you happen to pass away while that grandchild is still a minor, then the inherited Roth account that they would then need to open in their name would actually be a custodial account. There'd be an adult on there. And then second rule, you might be familiar with the 10-year rule. So they changed the nature of how you treat inherited IRAs, Roth IRAs, in the Secure Act 1.0. And there's now this 10-year rule. And that means instead of for pre-tax accounts where you could stretch it out, do just a required minimum distribution for the rest of your life and stretch this asset over your entire life, it's now 10 years. But the change was also made to Roth accounts. 10-year rule applies. Previously, it was a 5-year rule for Roth. For inheriting a Roth before the Secure Act, there are no required minimum distributions on Roth IRAs. Therefore, that stretch IRA rule did not apply to Roths. And so the subsequent rule was, well, if there's no RMD requirement, then the account needs to be emptied by 5 years. So we actually have an extra time under the new law. Mm-hmm. But for a minor, you get extra time because when does the 10-year clock start? Not until they reach the age of majority or age 18 for most states. Therefore, this could be a way, and those are just the laws, those are just the rules. It could be a way to shelter these dollars and have them grow tax-free for a little bit longer time period. I'm not sure if that's the angle of your question. If so, I applaud, like fantastic. Yet at the same time, I would really check the maturity and character of these grandkids before doing so.
And it's easy to judge that, no matter what age. But I would think, I would think in terms of, it depends on the amount of money, whether you would put it in a custodial situation or you would put it into a trust. And so, and I am nervous because when you see what happens to kids as they grow up and, things change in their lives, and it's tough. If you said, I don't have to take any money out of this account until I'm 18, and then I have to start taking it out between 18 and 28, for most people, that's not the most stellar time for them to be making great financial decisions. And if you're not sure whether I'm right, just tell me, is there really $1.7 trillion of student loan debt? Because that's where I would point to, you tell an 18-year-old, look, you pretty much have unlimited access to as much money as you need to take to go and live your life someplace where everyone is just like you. We've dug ourselves a pretty decent hole.
Well, I was actually going to use a different example. I mean, Kevin, in your own personal life, you've seen folks that have inherited some money as minors, and the fears of what you might read about that could happen. I think you've seen them happen.
Absolutely.
And it's heartbreaking. And so, I'm going to add one other thing to the positive. Not that you should do this, but wow, this you could really parlay this, and it could catapult you into a great financial decision. Is with the Roth IRA, inheriting a Roth. I've done some videos and created some content on the YouTube channel about, well, if you inherit a Roth IRA, is there any way to just keep it in a Roth forever? Well, there's a 10-year rule, but that answer isn't no. As a kid, you're likely working at age 18 or a part-time job or something like that. And if you've got 10 years to draw the money out, certainly by age 27 or 28, you better be working. And if you are, could you be funding a Roth IRA for yourself? Well, if at that age you're saying, well, I'm just still trying to make ends meet. I'm not earning a lot. I'm trying to grow in my career and so on. So there's not a lot of disposable income. I'm saving what I can, but I can't max out accounts. Well, if you've got an inherited Roth IRA at your disposal, you could start pulling some of those dollars out of the inherited Roth, investing it, contributing it into your own personal Roth. And therefore, you've taken grandma's money that's in a Roth that's been growing tax-free forever and grow it over your entire lifetime tax-free.
That's right. And that's the logistics, right? Like you have to be pulling the money out during your 10-year drawdown period. And it will be a moment of truth each time as you're drawing out of this Roth IRA. Am I going to put it back into the Roth? Am I going to let it continue to grow long term? But once it's into your Roth IRA that you're contributing, to your point, Mike, it can be there for the decades. And that's pretty powerful. That's maybe another alternative for the grandmother to consider as well. Do I just gift the money to this grandchild and let them make a contribution along the way because I'm going to sit them down, I'm going to counsel them and coach them. Hey, I want you to see the power of a Roth IRA over the decades, having tax-free growth over a long period of time. I've been the beneficiary of it. I want you to be as well. And now they're playing an active role while you're alive and kind of holding their hand a little bit. You're teaching them to be a contributor, to be a saver, and helping to facilitate the whole thing.
Yeah, if you had $100,000 and you were 25, you could put $30,000 a year between your Roth IRA and your Roth 401k, and you could burn through that money, and now it's still in Roth, and it will stay in Roth for your lifetime.
And so where we started with this question was, well, what 18-year-old or what minor has the character, the maturity to have that delayed gratification and hands off? Well, they might not. You might not. And that's why you need a coach. And I would argue if you're considering making grandkids a beneficiary of the Roth, I would consider having them get started with a coach that can help them get the right habits and get on the right financial track to be able to plan for this money well. So great question. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.